This presentation is for information purposes only and doesn't constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading foreign exchange, futures, cryptos, and equity markets can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. Hi, this is Ahmed. Welcome to session 3. Here in this basic class, we will discuss some of the key factors which help us measuring the market movement. Basically, market moves on demand and supply, but it's measured generally in price action, which is through the technical analysis. Because the technical analysis are based on the fact that history repeats itself. So, based upon historical data of any product, we can forecast its future move, which is helpful for our trading decisions. So it's a very vast field, but since it's a freshers class and idea is just for the overview, so we will go through some of the basics, and details can be seen in Professional Market Trader Diploma, which is of 26 exams, as we have discussed it before. There are practical assignments and MCQs based testing conducted online and backed by practical trading evaluation softwares, which is connected to any trading platforms. And upon evaluation, we had some funded real accounts with 50% profit sharing, which is in collaboration with some of the counterparts. And there's a certificate as well. We'll discuss about it in a separate video. So for details on technical analysis, you can go through the other videos related to any particular topic. So let's start the overview of technical analysis. When we talk about charting, so there are three types of charts. First one is line chart. Basically, we can use opening prices, or average prices, or highest prices, or lowest prices of any particular time frame to draw this line. But generally we use the closing prices, because closing prices are the most important prices, and so that's why we use line chart on closing prices. So this is the basic format. I hope everyone must be familiar with this already. The second type, the next evaluation from the line chart, is the bar chart, which is also known as American bar chart or OHLC chart, which is open, high, low, close. Because in the bar here you can see whatever the time frame of the bar is. It could be of 1 minute, 5 minutes, 10 minutes, 15 minutes, hourly, 4 hour, daily, weekly, or monthly. Apart from this, it will look like this. On the left hand side will be the opening price of that particular time frame, and this is the highest price traded during that time frame. For example, if this is of 1 day, so this will be the opening price of that particular day. This is the bottom representing lowest price, and this is the highest price, and on the right side it shows the closing price. And then the next bar starts. If this was the closing price and this is the opening price, and likewise this is high, low, and close. It's shown generally like this, or in most of the cases this is shown in colors like this, where the bullish move is represented in green color and the bearish move is represented in red color. The third type of charting, and the most commonly used one, is the candlestick charts. Candlestick chart, also known as Japanese candlestick chart, shows the same information as a bar chart, but most people find it easier to read. So here, candlestick versus bar chart, if we compare, as we just discussed, this is a bar with this open, close, high and low. So we simply combine opening and closing prices to give a filled body like this. It can be a bullish one, which is generally represented in green color, but whatever you might choose. And this is where the closing price is above the opening price, which is called a bullish candle because market is going up. And if the bar is like this, where it was open here, made a high, made a low and closed lower, when we combine these 2 points in such case, it gives a filled body again, but this is represented generally in red color or whatever color you might choose, but this is a bearish candle because the closing price is below the opening price. The official parts of a candlestick are named the real body, the upper and lower shadow or wicks. People also call the shadow tails or wicks. A candlestick where the closing price is same as the opening price is the doji. It does not contain a real body because the opening and the closing prices are same. There are a lot of types of the candlestick as well, which you can find in my other lecture where we discuss candlestick charts. So this is just for the overview. So generally it looks like this. If you chart it on any trading platform, generally these bullish candles where the opening is lower than the closing are represented in green and other are in red. Then there are trade-based charts. Trade-based charts are not anchored in a specific time frame. They depend on a certain amount of trading activity to trigger the next bar. For example, tick charts or the volume charts. Let's discuss these two. Tick charts generally normalize bars to market volatility, and it's good for looking at data during a slower time frame or overnight session. And because when there is low activity or more activity, so it makes a difference. So on every tick there is a bar or candle which is represented like this. This is the shortest type of time frame you can say. Volume chart. Volume charts are very similar to tick charts but use a specific volume quantity to trigger the drawing of the next bar. For example, a volume bar chart could be based on 1,000 or say 10,000 contracts. Volume charts therefore take into account each transaction size instead of just counting each transaction as a tick. Dynamic price charts. Price action charts are not based in time or volume or ticks, but based on specific price action to trigger the next bar. For example, range bar, Corgi bar, Renko bars, line break bars, point and figure charts. Range bars are based upon a tick price range. For example, a 4-tick range bar will not draw a new bar until the price action moves beyond the current bar's 4 ticks. For example, in the E-mini S&P, the smallest tick increment is 25 cents. So a 4-tick range bar would equal 1 bar per S&P point. 4 ticks of 25 cents makes 1 full point. So if we set it to 1, it means whenever S&P will move 1 point above the previous price or below the previous price, then the new bar will be generated. If it's above, then it will be a bullish and green colored bar. If it's below, then it will be bearish or red. Line breaks bar. For example, if the line breaks parameter was set to 1, then the price only has to exceed the high or low of the previous bar to form a new bar. If the line breaks parameter is set to 4, then a new line is drawn only if the current price exceeds the highest high or lowest low of the last 4 bars. So we can set it to 1 or 4 depending upon the market activity, and it's sometimes really helpful in the trend reversal. Likewise, there are some other charts. Renko bars. At this stage you just want to be familiar with these, because if we go to details it will be very detailed video. But obviously you can find all these in my other videos in detail. Point and figure charts. Then we come to the time frames. Generally we use weekly time frame for some significant levels which we will study in a few minutes, and weekly charts are very much helpful in determining the trend of the market. Then there are weekly time frames, and then there is daily time frame. So in daily time frame, obviously one candle is representing the move of one day with this lowest price and highest price, and this is the opening and the closing price. And as we discussed before, if the closing is below the opening, so this is bearish candle. Then another important time frame is 4-hour, because in 6 candles it represents 24 hours move. Then 1 hour or 60-minute charts, which has 24 bars showing this one-day movement. This is next day movement. Whatever time frame triggers the trade, which we will discuss in detail when it comes to practical trading. So apart from this, we'll have to use some higher time frame and as well as some lower time frame charts as well, which are helpful for entry and exits. For example, if the trade is triggered on daily basis, maybe for entry we'll have to use the 1 hour chart or maybe 30 minutes charts, and likewise for stops maybe we'll have to see weekly charts as well, or 4-hour charts. Likewise, this is 30 minutes chart, and with 48 bars it comprises 1 day's movement. 15 minutes, generally we don't use or recommend using time frame less than 15 minutes for any trade triggers until somebody is really scalping or day trading. Likewise, this is 5-minute chart where every candle represents the move of 5 minutes. Now, once we have gone through what are the basic chart formations, let's move further. Generally, you might have seen some traders having chart like this. So too much stuff on the screen. How can anyone trade like this? Maybe some of the indicators are required, some are not required, but we'll have to use it in a professional way. Let's go through each one by one. A pure price action trader can start doing their analysis with a chart that looks like this, with swings, key levels, trends, consolidation, and space can all be identified without a single line on the chart. Starting from this, we then move to trend lines and significant levels. We will discuss significant levels shortly. These are key areas where market had been reacting in the past, and we draw them generally on weekly charts with the last 10 years historical data. Generally, we will represent in blue the significant levels, and this is the trend line, which we'll also discuss shortly. Then gradually we use some of moving averages and the Gann levels, which again we are going to discuss. Let's start with swings, because these are very important. A swing high is formed by a bullish move followed by a bearish move. So this is a bullish move. High is higher comparatively on every bar. Then this bar is the highest bar. After that, bearish move starts. So such a move, this is the swing and this is the swing high. When looking for a swing high, a key pattern to look for is a bar whose high greater than the high of the bar on either side, which is this one. Swing low is formed by a bearish move followed by a bullish move. When looking for a swing low, a key pattern to look for is a bar whose low is less than the lows of the bar on either side, like this. These swings are very helpful for the trading, so let's discuss it in a bit more details just for overview, although we have separate lectures for that. When a swing high or low is confirmed, so we'll have to look for it. Many people just confirm it visually, like we can see, okay, this is swing low, this is swing high, this is swing low, high, so on. But the best way is to set an exact rule so as to make a principle and the plan to give us confidence in our trading. Let's discuss one basic rule here. 3-bar confirmation rule. Good method to confirm a potential swing. In this case, a swing low 3-bar higher on left side than this swing low, and 3-bar higher on right side than the swing low, like this. If there is a confirmation like this, so it confirms the swing low is made, and we can come up with multiple strategies we'll be discussing later, with maybe the stop below this line, and we can buy above this in combination of many other strategies we'll discuss. But right now we are just discussing some of the basic formations. In real chart example, you can see like this, 3 consecutive bullish bars, and this is the confirmed swing high because this is followed by this bearish move, right, and so on. Again, 3-bar rule market example, you can see this is a bullish 3, bearish, and this is almost same but the lowest point, so this swing is confirmed here, and still it will give us a move ahead. Replacing bar with the swing lines, we can easily see this is swing low, swing high, swing low, and so on. But you see, market moves in swings and in symmetrical patterns, and further we will discuss how market move is changed from bullish to bearish using these swings. Because market moves in trends, so in an uptrend or bullish market, the price action has to make higher swing highs and should also generate higher swing lows. Generally, it's not all the times. Likewise, we can see here, this is swing high and this is the higher swing high. This is again higher swing high, so that's why we can see this is in an uptrend or bullish trend. Likewise, in a downtrend or bearish market, the price action has to make lower swing lows and should also generate lower swing highs, like this. So let's further see how it varies if we talk about bullish or bearish move. So there are certain differences between the candles or swing highs. So bullish swings, if the high is slightly higher than the previous one, so this is slightly bullish. If it's comparatively more higher than the previous bar, it's moderately bullish. And if there is too much difference, as you can see here, market close here and open here and all the way it's up, so it's very bullish, which can be represented like this. Likewise, for bearish swings, this is slightly bearish, moderately bearish, and very bearish. This will be helpful in determining the change of trend like this. See, uptrend change in direction. Example 1, uptrend reversal. So here we can see its combination of moderately bullish to slightly bullish, and then it start moving down. So here swing high is higher than the previous one, again higher than previous one, low is also picking up, but here's all of a sudden it moves down and breaking both the swing lows. But yet we cannot say the trend is changed till here. We can say possible change in trend based upon this. Once market start moving up, then we set the rule, if this low is broken, then we can say the change in trend is confirmed. This is how we save ourselves from some of the dodgy moves. Likewise, in example 2, you can see it's almost same till here, and after this it is again possible change in trend, but when it will break this low, but this time it didn't break the low and made up all the way and break this high, so we can say uptrend continues and the trend is not changed. Likewise, in downtrend examples, you can see here it's a reversal example. It was moderately bearish, slightly bearish, and then after that this makes situation like this and again start moving down. But when this is broken, so we can say till here it was possible change in trend, but once this is broke upside, so change in trend. Before the market was bearish and it was gradually turning from moderately to slightly, and then trend is changed here from bearish to bullish. And it's example 2. Here we can see till here it's same situation, but it did not manage to break this point and come back again. Then upon this we can say downtrend continues and the trend is not changed. So these are a few examples of the trend and reversals. So right now we are just discussing some of the basic formations, and one of the most important is the space. This is comparatively a new concept to many of the traders, even they are experienced. Space is a series of same colored consecutive candles which provide a smooth transaction like this in the bearish one, and like this in the bullish one. This is the free space available. How we utilize it? Look right to left from here, because this is the current price. If we are planning to sell it here, for example, so we have this simple space available because all the color candles are of same color. So we will look right to left always. Ignore the candle shadows, these one, the wicks, this one. As soon as you hit a candle, look up or down to see if there are multiple consecutive same color candles like this. Likewise, in case of bearish move, we see this is a simple space from here till here, excluding this shadow, and it gives us very helpful idea and very profitable trade some of the time. If we had to buy here, so we believe market could go till here to fill this smooth space, which is a simple space. Then there is another concept of advanced space. If only one candle is of different color and that's not reversing the move, slight retraced and then it continues, then we can give exception with the one candle only to accept it as a space as well, and this is called advanced space. Like this was a simple space and this is the advanced space because there is only one candle of opposite color. Or if this is a bullish move, all these 1, 2, 3, 4 candles are bullish and one is bearish, but it's not reversing the move, so this is called advanced space and it has this similar impact. But it becomes invalid if there are more than one candle of the same color, or the retracing candle of opposite color is of large real body, or there is another option, it has very long shadow. Quick recap. So far you have learned about charting, time frames, price action and swings, closes, candlesticks, space, and somewhat about the target built in with the space. We have taught these classes in a very specific order that is built on each other to provide a solid foundation for which to begin to understand price action trading. Now we are finishing this series of classes, the concept of location and volume, and because again this is just overview, so let's continue with location and volume. In trading, a location does not just mean a location of a specific price action event. A location could be a reaction to technical indicators or technical levels. It can also incorporate the time or date when that event happened or might happen. Location can mean a spot on a chart that has nothing to do with time or date. Examples: prior major support or resistance, a trend line, a channel line, a significant level, a major moving average, distance from a major moving average, a Bollinger band, pivot lines, Fibonacci or Gann levels. All these are location based and are not based on a specific time frame. For example, if these are the swings, this is a support line and this is the higher side of Bollinger band and this is the cross of moving average, so it's happening regardless of any time frame. Whatever the time frame of this chart could be, it doesn't make any difference, but these are the key areas which we should know. Likewise, as we just studied, these are swing lows, swing highs, and resistance points, support lines, some other congestion area, floor, ceiling, which is also a resistance line, and as we know, support becomes resistance and resistance becomes support. So multiple concepts. So these key areas all are example of locations. Volume. Volume is indirectly very helpful indicator. As you can see in this move, from this candle onward up till here, although this is a bullish move, market is edging higher, moving up, up and up, making new highs every candle, but the volume was coming down gradually. So what happens ultimately, it turned the market bearish. So likewise, we have some indication that if the volume is not picking up with the price, so it can be a reversal as well, which we will discuss further in collaboration with open interest as well. Sometime this is example of exhaustion move. Here we can see in this candle it made the highest high and the volume was in line till that, but after that we see in next few days volume dropped, although it started moving up again. But this indicates the market is exhausted enough and it's ready for profit taking or short selling. And this indication first came with this volume analysis, and after that you see market start moving down, although there will be some other factors as well. This support line is broken, this swing high is made, this is a rotation zone, moving averages could have been crossed here. But apart from all the indicators, this standalone indicator volume is enough for this kind of exhaustion moves and reversals. Likewise, here we can see again, here the volume was coming down, although market was going up. So that it was a contradiction, but ultimately it started moving with the swing and turned all the bearish move to a major. So sometimes these small indications really help a lot. Although it's not a standalone indicator, we don't generally trade only looking at the volume, but in conjunction with our other indicator that we use in our trade plan, and the trade is triggered, so we have more and more reasons to make more logical trades. It gives us more profitable trades as well as confidence in our trade plan. This is on balanced volume example. This is same, and it's adjusted volume, and it's represented in line like this. So here we can see market was coming down, but it was flat, so it was not coming down. So gradually market start moving up from here. Likewise, prices were making new highs and going up, but it was flat, so it rejected to move up. So gradually market start moving back in a bearish tone. Apart from volume, another factor which is really helpful in determining the move is the open interest, especially if we talk about commodities and exchange-based futures, where we have commitment of traders report published weekly. So we can see what is the open interest, I mean the net opens, whether they are in buying or selling or whatever it is. So here is the relation. You can take screenshot of this. This is really important to understand the correlation, that if volume and open interest both are rising, so it's a trend confirmation, and if volume is rising and open interest is falling, so it's due to position liquidation or profit taking sometimes. And if volume is falling and open interest is rising, it means it's slow accumulation for the new trend, and it's not the trend reversal at all, which is generally considered. And if both are falling, so it means market is in congestion. Still we cannot predict it's a bearish or bullish until we compare it with the current price. If the price is rising, volume is rising, and open interest all are rising, so it's a strong market. Likewise, if price is rising, volume is falling, and open interest is falling, so market is weakening, although the price is rising. And if the price is falling, but volume and open interest both are rising, still it's a weak market because it's a bearish market. Price is going down. But if price is falling and volume and open interest all are falling, so it's not a weakening market. Basically, market is taking breath for the next move, and it's a strengthening market instead. Now let's start with the very important trend line concept, which is the base of the technical analysis. It starts with the line. A line which is drawn in such a way that if the market is upward sloping, and we take a lowest low of the candle, and at least we need to have one more candle to coincide. If it's more than that, it's good. So this anchor point is called initiating point, this is confirming point, and this is validating point. Traditionally, we need to have at least these 2 points to draw the line in such a way that if it's upward sloping, no price action should be below this line. So this is called a traditional support line or trend line. Likewise, if the market is bearish one and this is downward sloping line drawn in similar pattern, we need to have at least 2 touches. This is the initiating point and the confirming point, and validating point, or if there are even more touches make it more powerful resistance. And once this is broken, we believe this resistance will become support and market is now resisting to go up, but after that this line will support it to go down and prices will move higher, and we use it for entering the trade on the breakage, whether it's upside or downside. Then once we have this trend line, this is the initiating point, confirming point, it's a valid trend line because no price action is below this line. We made a parallel line to this line, which is not a trend line. You need to know it, because most of the traders say this both are the trend line, but this is the trend line because the market is upward sloping, it's a bullish market. This is just a parallel line and we call it the target line. So it's important to know the difference between a trend line and a target line. This is if we buy here, so we are targeting the price to come to this level to exit, whatever our strategy could be. But in such a move which is upward sloping, this is the trend line and this is the target line. Likewise, if we have to redraw the lines, so we need to know what are the trend lines which are valid. This is very important. I have seen many novice traders having too many lines on it, and most of them are not even valid. So this is the example of trend line we just discussed with the 2 points, initiating point and the confirming point. So if we have to redraw based upon such a move, so again this will become new initiating point, and we need to have one more touch, which is here in this situation. So we draw this line, which is a valid line, trend line as well, because no price action is below this line. Again, we can draw one more line here. So likewise, whatever number of lines you draw, these are valid lines and all are trend lines. But if you draw a line in such a way, for example from here up, so this price action is down, it will not be valid, and we will have to remove that line or redraw upon the close of the candle. If any candle closes below this, so we'll have to extend it down. So likewise, this is example of bearish move. Here obviously this is the trend line with the initiating point and confirming point, and this is the parallel line drawn, which is a target line, and this makes a channel, and market moves in channels, whether it's upward or downward. It's very important to understand. Now let's discuss trend line targets. It's very simple and built in. This is the trend line we just discussed. This is the initiating point. and this is the confirming point. Here it's broken, and we also discussed this is a support line as well, because this is upward sloping and it was bullish move. So once it's broke and we enter with the selling price with the stop possibly above this point, and we will discuss a lot of other factors, but this is just for the basic overview. So every trend line has two built-in targets. First target is this defining point or the confirming point, and second target is the initiating point. And this is, as I said multiple times, real market example. And here we see market achieved this target and then second target as well. And most of the time it happens. Sometime it might not happen and only first target is achieved, and then there is another price action followed by a lot of other indicators which we discuss and implement further. Whatever we have studied so far, we can add gradually. Like this is the trend line, it's broken here, and these red lines are the three possible targets for this. This is the first target, being the confirming or defining point. This is another second target, as we just discussed, the initiating point. But here in between we see this is a smooth space available. Looking from right to left, we see after this could be a very good point, because we just studied it's a simple space and we expect it can give smooth move. So likewise we might have three targets for this trade, which we can utilize in multiple ways depending upon our strategies, which we are not discussing here, but we should be familiar how it can be used. Then another important concept is the piercing bar, like this. This piercing bar is a reversal pattern. Here we can see piercing bar closed even green, conservative entries, and there are two types of entries which we can make whenever we have such situation. This was a trend line redrawn. This was the initial trend line. We draw this another valid trend line based upon these 2 points, and this was another touch. Here it tried penetrating and breaking this point, but ended up with a large shadow, which is called piercing bar. If there is such a situation, generally we enter on break of the line, but since we know piercing bar is a reversal, and here generally we enter upon the close, we see this is the bottom and the lowest price of this bar. So here we should enter with selling with the stop above this piercing line, and once this is broken, this would be a high probability trade, but if we have to trade in between, that will be a conservative entry. So waiting for the close always give us high probability trades. So you should also understand such a situation where the piercing bar is there. Although we have detailed lectures on piercing bar in respective class, but this is again just for the overview how we can utilize this situation. Here we can see it's a combination of some other studies which we'll discuss further, but generally trend line we can use for support and resistance line as well. Like this was a trend line and it coupled up with a few other indicators, like this is a significant level which is drawn on weekly basis and it is coming from last 10 years history, and we see this is coinciding with this point, and here you see this is a piercing bar. So in such situation again we will enter on next candle when it's breaking the low of this piercing bar, so it can give us very good entry with a stop above this point. So we can look for such good odds. That's another example of piercing bar. This was the redrawn, perfectly redrawn trend line with this initiating point, confirming point. Here again 2 times it exactly touched this line and bounced back, and here it tried penetrating but it could not break and closed well above this line, making this a piercing bar. But as we know, in piercing bar we can have reversal entry which is bullish one, but we will enter here once the high of this candle is broke. Now let's discuss another very important concept of significant levels. How we draw significant levels. As I explained before, we used weekly charts and study the moves, the swing highs, key areas, and emotional candles where market has behaved emotionally, abnormally, and note down those areas, and based upon it we use generally last 10 years history to draw the lines once for all for any product. It's whatever the time frame we might be using in future to trigger the trade. It could be daily or 4 hour or even 30 minutes or 15 minutes, but you will see a huge impact whenever prices come to those areas. You'll need a lot of practice for that. So here we have highlighted some of the candles you can see in yellow. These are emotional candles, like market is moving comparatively abnormal here. Like here we can see for the last few weeks market was in consolidation, range bound, and once this area is dropped there's a fast move. Likewise here we can see all these candles. Here you can see it's big bearish candle, and again it's followed the move, similar patterns. So first we have to mention which are the points which are affecting reversal moves, or some bullish candles or extremely bearish candles. After that we have to draw levels like this blue lines. We'll go for practice on live charts as well, but this is just for the purpose of the lecture. We have covered some of the areas of this weekly candles where every candle represents 1 week move. So here we can see we generally use either the highs or the closing prices, because closing prices are the most important prices. You should keep in mind, it's really helpful. So here we see this is the closing price of this bearish candle, this is the closing price of this bullish candle. We combine these, so you see it reacted again here in future. If we draw this line based upon only these 2 points, you will see, as we know, history repeats itself. So after so many weeks it came back to this level and could not break, and there is huge move down. for the loss consecutively 2 weeks, which can give us very good entry at this stage if we had already drawn this line. Likewise, you see again market came to this area, so importance was increased instead, and again it was huge bullish move. So after that, once it managed to break this point, this area, this level, which is a significant level, market is moving all the way up. So likewise, we have to mention the points where market is behaving abnormally, and while considering some other factors, but for the simplicity's sake I'm not going into details, but these levels, believe me, will change your trading because you will find it too much helpful. We can also find these levels for the confirmation on the line chart, but if that line chart is based on closing prices, and we can see repeating closing prices, more touches we have on closing prices represent this is really a significant one, and you will see the impact in future whenever price comes to any of these levels. So another examples here you can see, for example, this line, 2 closes, this the highest, this close high of this move, near this high as well, all these filled bodies bottom, filled bodies tops. So like this you will have a practice drawing these. Again, you see here excluding the wicks, bottom of the filled bodies. Here you can see multiple time tested this area. This is the highest one. This we exclude the wick. This is the closing price. After that, again after 4 weeks, after a month almost, market came back to this level, couldn't manage to break, and then finally drops. So again it came to this level, first time it could not manage, came down, and once it managed, you see it's entirely different move. So likewise, it needs a bit practice, and it will be really helpful for you once you know how to understand and draw significant levels. Another examples which you can watch multiple times. By stopping this video, try to understand it and then draw them on your charts and see the impact. Another example you can see. So once you will draw the significant levels, and in combination with the trend line break and some other strategies, you will have more and more reasons giving you more and more confidence to your trade plan. Like these were 2 significant levels from the previous one. We draw it on last 10 years basis, and you see how closely it's impacting. Once you will draw them in real, you will see the difference. So after that, let's discuss few more concepts. Although we have separate set of 4 lectures on Fibonacci and Gann retracements, but as we discussed, this is just for overview. I want all of you to be familiar at least with some of the basic terminologies and the functionalities, although we cannot cover all here. So as we discuss, market moves in trends and channels and swings. So if the market is bullish, so it means there can be this retracement as well. Market always move in swings, whether it's trending up or down. So Fibonacci and Gann retracement are the measures to check how much market can retrace without considering a reversal. In Fibonacci, generally we have three major levels. If the market is moving up and it starts moving down till 38.2% of this move, starting from the swing low to swing high, then 50% and then 61.8%. Till these three levels, we say it's not a trend reversal, this is just a profit taking. Whoever could have been buying here or below, they simply sold it here and market came down, but this is a profit taking, and we expect market can start making a base and it can make a swing low and then start moving up. Let me explain it in a live chart for a minute. For example, this is the weekly graph of crude oil. As we have studied the trend line, let me quickly, because generally it takes more time, but swiftly trying to draw some of the things we just covered. This is a valid trend line with the initiating point here, and then this is defining our confirming point. So now, if we have to make a Fibonacci retracement, here you see this button. This is available in almost every trading platform and charting system. So this is the anchor point from where we draw. This is the bottom, and we take the highest high till here. It automatically draws, and we can see market can come to this level and then this level, and this will be 38.2 retracement, and we see multiple congestion areas here as well where market may consolidate, and this is the weekly. This is basically how we draw these. We can make another Fibonacci retracement. If you see here the prior swing high, and here since it was extremely bullish, so from this point it did not even came back to 38.2 retracement level. It simply came in between 23.6 and 38.2 and then start moving back. We'll just study in Gann, the levels are 25%, and so it came near 25% and start moving up because it was a very bullish market. This is a weekly, and if you see in daily and you just want to measure the market, this is the swing low and this is the highest point. So if you just want to see in the daily, here market start moving down, so what is the potential, how much it can further come, along with other indicators. Here you can see this is the 50% retrace. Market already tested 38.2 and then start moving up again, and if it start moving down again, the next level could be 50%, but this is not a standalone indicator. We have to have a lot of things, like for example we just studied significant levels, and this is a weekly chart. So starting from here, for example, if you see, this is a point in weekly chart which you can find have multiple reasons to be considered as a significant level, because this is the, excluding these wicks and tails, the filled bodies are below this line, and you see the impact once it's broke upward. Till now it's now coming back. Likewise, you can find some other levels as well. It requires a lot of time, but just swiftly moving on just to have a bit overview that how it can really work. Here you can see this one, likewise this one. You see from here, this was the top of this candle, bottom of this candle, almost low of this weekly candle. Then closely, if you could have drawn based upon this, it reacted here, and you will see it will react again whenever market comes to this level of around 60, 59.42. Likewise, this is something which you'll have to draw once. Here you see it has got big importance, and based upon this, maybe you draw this level once the market was here, for example, and this high was made. After that, you see market came here and too much congestion. It could not break in 1, 2, 3, 4 weeks, almost a month. It made a high consecutively near this price and then coming back, and ultimately once it's managing, it managed to break up, and after that it went up straight. So this is a bit overview of these significant levels on weekly charts. After that, we have only one more option of this significant level here. So in future you can see whenever market will come again, if it managed to broke this level, you will see a major move. And likewise, once market start coming down and comes to this level, you will see the reaction. You can change it to daily. So in daily, this level is coming here, and you can see when it comes to this, you will be conscious, and you will already see this is another 61.8 retracement level as well. So these are the two reasons you have to accept this as an important level. So likewise, you will keep on adding the indicators, and they give you more and more reasons, and you can start using them. Anyway, this is just how to draw these Fibonacci retracements, because this is just a retrace. Market is retracing from this point, and it achieved 38.2 and then could not touch this 50% retrace because it was so bullish in nature. It continued its trend, and again, since it was a level, and it started moving down from this, because this was a significant level. We just draw based upon these things. It was drawn on weekly basis, but you see when market comes to this level, it start moving down. So these, still we can say this is a retracement until this level is not broke, because this is 61.8% and as well as a significant level as well, and we believe market can maximum come to this level and start moving up again, so which still will not be considered a reversal. So this is how we measure the retracements basically. Coming back, so this is the Fibonacci levels, and these are Fibonacci price extension as well. Like from this low and high, we measure the move, and then we draw from this projected point another similar parallel 100% move and 161.8 likewise. So these are the projected targets which help us forecasting the prior move. Like in previous live example, if the previous high broke, for example here, so where market can go up, so this can be a projection, and these projections are helpful like this. Likewise, there are reverse extension as well, and some more which you can study in detail in my Fibonacci and Gann levels lecture. The most important angle, Gann called 1 by 1 R45. We personally prefer the Gann because of its symmetry. If you draw a perfect square like this and then draw a diagonal line from one of the corners of the square to the other, you have illustrated the concept of 1 by 1 angle R45 angle, which moves up 1 point per day. So based on Gann's rule of 8, which is derived by dividing a circle into 8 equal parts, calculating the levels of octaves. So by dividing this, we have these levels. Which you can see have comparison with the Fibonacci. There is slight difference between that. That was 38.2 and here it comes 37.5. That was 23.4. It is 25. Slight difference, but because of its symmetrical octaves, we see more reaction on the Gann levels. Likewise, in the shape of swings, if you see, if this is 2 up, 1 down, 2 up, 1 down, 2 up, 1 down, 2 up, 1 down, so this is a swing basically. This is 2 level of Gann and 1 level of Gann down. Likewise, this is 3 level up, 1 level retrace. So this is in extremely bullish case scenario, and this is 3 level up and 2 level down. So we have different symmetries which we measure from Gann moves, but this is just for the idea. At least you will be familiar with the terminology used in the technical analysis, and again, for in-depth knowledge and practice, you need to watch the other lectures and have more and more practice. These Gann lines you can draw on charts, and then you can watch the reactions like this when it comes to this level, and along with combination of other what we have studied so far. Then you can clean up the charts by coinciding some of the levels. For example, you can make clusters. If this is a Gann level and this is some significant level, it's coinciding. So you can note this area here, and you see here it's also reacting. So sometime you'll have to note multiple levels based upon multiple indicators, and then you can watch them and make some clusters. If, for example, this Gann retracement was drawn from this point to this point, one is drawn from this point where the anchor point is this, again to this, so these are two different, and these are clusters which are coinciding by different levels. So likewise, once you will have some practice, you will see like this is 62.5% of Fibonacci and this is 75% of Gann. So in between, you see when market came to this, it made a huge impact. So more knowledge you have, more beneficial for you, and you can utilize Gann in multiple ways. Here in the combination of end of space as well, this was space. So many concepts you can combine by the time you know more and more. Likewise, there are Gann box extensions. If we make a symmetrical Gann box extension with one up and forward, so we can see the boxes like this, and we can see the impact on every line. You can see if this is broken, the target is the next line, then so on, and how it is, apart from any other technical indicator, it's behaving, its reaction you can watch here. And likewise, once this is gone, broken up, next target is this next box, and you can see how it's behaving on every line of the scan box, although there is no other indicator right now. So this is how, when in conjunction with other indicators, you'll be using these extensions. It will be helpful as well. Likewise, these are reverse extensions, and in stop loss and targets, they are really helpful. We'll study this in detail in Gann lectures. Once it's broken, where we forecast it might move up, so extensions are really helpful for such evaluations. Now let me give you an idea of moving averages, another very traditionally used and the old and widely used indicator. Moving average represent the average move after a certain selected period. If a moving average of 20 period is drawn, it means based upon the last 20 candles, whatever the time frame could be 20 days, could be 20 hours if it's hourly candle. So it's drawn. Here we can see, just for explanation purpose, we have drawn same 20 days moving average. There are certain types of moving average which we are not discussing here. Generally, we mostly use simple moving average and exponential moving average, sometimes weighted moving average and displaced as well. Some other types are there. You can watch the set of 5 lectures on moving averages for more details, how they are developed and calculated, and what is the difference between the exponential and simple moving average. Right now, being the basic one, just want you to be familiar with the basic concept. So these 5 lines you can see all are drawn on 20 days moving average, but one is drawn on the closing prices, one is drawn based upon open prices, median, average prices, highest prices, and the lowest prices. Then you see there is slight difference, although we'll be using closing prices being the most important one. Moving averages basically help us determining the trend. Here you can see the blue one is 20 period exponential moving average, green is the 50 EMA, and this purple is 100 SMA simple moving average, and this is 200 SMA. So with the certain crosses, once we draw, once the shorter time frame average is crossed, the target is the next one, and so on. Here we can see this 20-day moving average crossed this 50-day, so the next target of the price was the next average. After that it was the next average, which came close to that in combination with other statistics like this trend line, and then these swings, what we have discussed, swing highs, these are additional factors. Very rarely we used only based upon moving averages. Sometime we may use when there are some crosses, major crosses, which we'll discuss. But generally these are used to determine the trend along with other indicators, especially when the market is diverging. And once the market is in range bound, we simply exclude the moving averages from our charts. Now this is 200 SMA. Here you can see this is acting here as resistance and here at support. Again, once it's broken, again it's behaving as resistance. So higher time frame like 100 and 200 SMA can act as support and resistance as well. And once we are here and we believe it was, bearish market, and this is just a retrace. In addition with our other trade plan and strategies, we have this additional factor that this is acting as resistance as well, just in case if we are planning to sell and we have already 4 or 5 other reasons. So this can be 6 or 7 reason to sell here, but not only based upon moving averages. But more and more reasons you have, more profitable trades will be there. Now moving average, as I just told, can be set as target. Once the lower is broken, the target is the next one. Like here, 20 is, broke down, so the target is 50, which is here. It tried, touches, but could not manage, but managed here finally. And once 50 broke, the next target is 100, which is done here. And after that, next target is 200, which is done here. So these are, again, once we are already in selling position due to some other factors as well, so they give more logical reasoning, so give us confidence and the reason to wait for the next level. Likewise, in combination with whatever you keep on studying, you keep on adding reasons. Golden cross. Classic bullish and bearish golden cross is basically 50 period moving average cross below and above 200 moving average. This could be a standalone reason to enter into a trade without any other indicator if there is a golden cross. You see here, this green is a 50 moving average. Generally it's SMA, and this is crossing from upside this 200 period moving average from this point, which I mentioned here in this blue line. So based upon this, if you sell, then you see after that it start pushing down, and here it made multiple reasons. Could be resistance line which is broken here, which can give you a reason to buy it back if you sold it here. This is the rotation zone. This is, congestion area, strong support. Many things happened, but still if you wait, that you will enter again. Here you see this crossed it back. So even if you exit here upon the cross, still you will be in reasonable profit. So this is called the golden cross, which is sometime very helpful because it rarely happens. Likewise, the shorter term combination of moving average which generally we use is 5 and 13 period crossovers. As you can see, 5 crossed 13 here, and after that it crossed back here. So it's based upon this, somebody could have sold here and bought here, and then again it crosses from above to below, giving a sell signal, and then cross back here, buying signal, and so on. Here you will notice one thing. It gives indication of buying here, not here. Although this line could have broken here, some other reasons could be there. This is a piercing bar, and as we studied piercing bar, we can take entry upon the breakage of top price, highest price here. So multiple reasons we can use to exit before it shows. And remember, moving average is a lagging indicator, so you have to keep this thing in mind. Then here one thing I want to mention you, during this consolidation or congestion, we generally exclude the moving average. We don't rely upon them once this market is range bound. Once there is diverging situation like this and market is trending whether up and down, then these crossovers are really helpful here, as you can see. But during this time we don't generally consider the moving averages when they are converging. So now multiple concepts which you have studied, we have studied these blue lines are, by the way, the significant lines which we draw on weekly basis charts. Now whatever time frame you are trading, whenever these come into action, you will see the reaction here. Market is behaving like it's bouncing from here and here. In addition, if there are some rotation zones which we called R zone as well, so it gives, you know, very good entries, and we are always looking for good odds. So keep on building the knowledge and keep on noting the points which will be helpful. Swiftly moving on to our traditional moving averages which we frequently used is 8 and 21 EMAs, exponential moving average. This will be really helpful in combination with many other indicators. This yellow orange is 8 EMA and this blue is 21 EMA. So whenever these are crossing, it can probably give you rotation zones and good entries. Just draw them, watch them, and have more and more practice, and when combined with the dynamic R zone, you will have good trades. Likewise, this is a trend line, it's broken, and at the same time we see it's a crossover here as well. So there are two strong reasons to sell here. And also there is R zone which we call once this crossover is happening. So this is a rotation of the moving averages. So this 8 and 21 crossover is very much popular, and as we saw it here, in collaboration with other idea of breakage of the trend line, it gives us very good trade. And as we discussed before, it could be a first target and it could be the second target, this area, and we have seen both meeting here. So again, adding multiple concepts. Here you can see the impact of these significant level lines drawn on weekly basis, you see how market is reacting whenever it comes to this level, like this here, here, so on. Once you will have practice drawing the significant levels, you will see the impact along with the moving averages. You see, this is also giving additive reasons for the resistance here. This is the R zone, crossover, significant level, so more and more reasons for you. Likewise, there were some Gann extensions and levels, and the R zone crossover, dynamic R zone with 25% Gann. So it is having bit support here. Market was going up, and this is the first retracement level of 25%, and you see price came in the R zone of these two moving averages, 8 and 21, and start pushing up. Here, whatever we have studied so far, I'm trying to give a few examples. The trend line broke. This was significant level as well, and you see piercing bar and congestion, and then this crossover. So multiple reasons, to buy here with multiple targets here and here. This is the end of whole move, which is the initiating point. As we discussed, initiating point and confirming points are the built-in targets of any trend line. So we use multiple concepts. One more important point I would like you to remember: whenever the market is trending up or down, as it always moves in swings and rotations, so like this, the first rotation, second, third, fourth. After fifth rotation, try to be cautious, because market may come in congestion or reversal scenarios or different formations. So up to 5, it's good to go if the market is extremely trending, whether bullish or bearish. And in normal conditions, at least 3 rotations we go for. Again, this is lining up dynamic R zones. R zone, as I told before, like this is the combination of 2 moving averages, and this space between these two giving us a zone, helping to turn the market in the direction and give us good entry points. When you are using the combination of 8 and 21, so if you look here, this was a trend line drawn based upon these 2 points, and then on shorter term, this was extended trend line which broke here. So if somebody is entering here with the stop below this point, for example, because this was a significant level on the way as well, having multiple reasons to buy, then the first target is 8 EMA, which is here, and the second one is 21 here, and obviously based upon this you can have some more targets. But since it was extremely bullish, bearish move, and it had a bit retracement, and it was not the reversal, so it was contained within this line. If it managed to break this line and the 50% retracement, we could have gone to end of space target here. Likewise, there are some multiple target trades as well, and I want you to understand one more concept of trailing stop. And you can trail stop based upon moving averages as well. Generally we trail with the combination of 8 and 21 moving averages, but unfortunately most of the charting tools comprising MetaTrader and Vertex and few others don't have this facility, but the NinjaTrader in the US and some others have. But you can use it manually as well by noting down the prices. So we will discuss this concept we have already discussed in the moving averages. These red lines we represent with the targets. So with the targets, if they are lining up with the R zone, these are another helpful factors. Again, this line broke. We are a fan of entering on breakage of the trend line. It gives powerful trades, and also, as we discussed, it has built-in targets and some space we have. So this was a cross as well, and if you draw this line, this was another resistance line because this support became resistance. It broke down and then again it tried to touch this. We also call it kiss the trend line goodbye situation, where it just touched this line and did not manage to break it and start moving down. So this crossover and break gives a perfect combination, especially if it's hourly or 4-hour chart. Like this is 240 minutes chart, 4-hour chart. So in such situation, it's very good to sell here with the stop above this significant level, where you can keep this red line as a target because of this end of this space, because the line was redrawn. Initially it was here, but as we discussed, we can redraw the trend line upon closing of every candle, and this was the recent most, but this target is too little, which cannot meet the reward to risk ratio, which we'll discuss in the next fourth and final chapter of this basic course. So we exclude this as a target, and then this was a good target due to end of space we just discussed. Dynamic R zone here, after breakage, kiss the trend line goodbye, prior resistance becoming support, and first crossover here. So altogether multiple concepts providing great entry to provide this is a rotation zone as well. So more and more reasons you have, more confident you can trade profitably. Again, this was end of space, so good target, good first target for the profit, and then obviously this was the other point, confirming a defining point being the built-in target of the trend line, which was also achieved here. So these things are helpful how you plan, and we'll go through it live. Likewise, here you can see it's a multi-target trade. First target we set this end of space, and second we set it here because we exclude this point due to this different color candle, and again it was kiss the trend line goodbye and then this rotation zone and crossover. In the previous example, as just we studied, so here this is the end of space, although it's close to the initiating point, but you know, when there is such a situation where there is a slight difference, you can twist it a bit and modify the target accordingly, making it more realistic. Gann extensions and double tops and other situations can also make good entry points. We are not discussing double tops and double bottoms here in detail, but just for you to be familiar, if there is a bullish move and after that it retraces, but the retrace should not exceed 50%, generally remain close to 25% and then start moving up again to touch that bottom and did not break that and start moving down, then we can say this is going to be an M shape or double top. This is the first top, this is second top. On such, we start selling once this level is broken. After breakage of this point, we are confirmed that double top is done, and then we have the target based upon multiple reasons which we can discuss further, but this is a traditional double top in real examples, and where ultimate profit target could be the end of the space here, this area. This is inverted double top, which is double bottom situation. In this way, the market should have in bearish move first, made this bottom, went up, which should not be more than 50% of this move, and again came near this level and start moving up. So this is potential double bottom formation, and we will enter upon, you know, whether if we draw a line from here and breakage of this line are to be on safe side above this neckline. This is another example of double bottom. We have separate chapter discussing double top and double bottom, where you can have detailed information about this. Another example showing the target realistically and the stops beyond this point, because whenever we go for real trade, we will be discussing in the next fourth and last lecture of this class of basic functionalities. So here, after breakage of this point, we generally enter, and this is the target and this is the stop below this point. This is for double top and double bottom situations, and we trail the stop as well as far as the market is moving up. We have different strategies for that. These are real examples. And after that, there is Let's discuss two more configuration setups to close this technical analysis class. Just we'll have the overview as it's already becoming lengthy, I understand. This is head and shoulder pattern. So as you can see, if there is a move like this which is coming as a bullish move and then it rotates, make rotation, then make move like this, so this is called shoulder, this is taken as head, and this is the shoulder. We have certain Gann parameters to check its validity, but a shape like this is called head and shoulder, and it's a very powerful trade setup once triggered. Likewise, this is inverted head and shoulder, and this is the neckline, and we enter upon the breakage of the neckline in such situation with a stop above this line, and we have certain targets which we have discussed in detail with the 4 lecture of head and shoulders chapter. So right now idea is just for you to be familiar with such setup. As you see, this is left shoulder, head, another shoulder, this is the neckline, and this is the fail-safe trend line, and we generally keep a walk-away stop above this, which we trail as move progress along with this line, which we will discuss in detail in related chapter or in the live examples. Like it was triggered here. This is left shoulder, head, shoulder, this is a safe line. Initial stop was here, we entered here. By the time it's sloping down, we give stop above this point anywhere in worst case scenario, which still ended up in profit, although the original target was not achieved. We also use best fit lines in this scenario to lower down the stop value, because the initial this is the trend line. Actually it's not the trend line, but this is the best fit line, making a line on the filled bodies. So instead of trailing stop here, we can trail stop here in such situations. Now in the end, let's discuss another important thing, the wedges. A shape like this is ascending wedge. Here this is the trend line, this is another, both are valid trend lines, and they are not making a channel due to this shape. Here we make a parallel line to this trend line. After that we make a parallel line to this trend line. So we have 4 lines like this, and this is the wedge. So market can break either side. If it breaks this side, we follow this as target. If it's breaking this side, we entry on break, then we sell it here, making a target here. We'll discuss this in Wedges chapter. And likewise, you can see this is a descending wedge. So it can have both side move. If it break here, we enter here with the stop below this line, and the beauty is we trail the stop as far as the market is moving upward, and we adopt this channel. If it's break this way, we adopt this channel. So wedge is comparatively complex to trade. Right now, just be familiar, this is another type of shape. If this happens, it can break, either way. If it break this side or this side, we take move accordingly, and there are a lot of factors which need to be considered as well. We also make use of Gann levels and some retracements. If it's breaking down, generally we have stop above this, and this is the profit objective. So after that, we have some more shapes which we have not discussed yet: the triangles, the flags, the gaps. There are 5 types of gaps, and you can watch the gaps videos to understand, because it's already too much lengthy, so I skipped few things. The idea of this class is just to understand what are the basic technical analysis and the formations we utilize for the forecasting, and it's equally good to forecast the move of whether we are trading Forex or cryptos or stocks or any product of the world, because all need data to plot a chart. We have so far discussed various type of charts and the shapes which need a lot of practice, and I believe it will be fair enough to give the idea of how we forecast in the financial markets using various tools, and look forward in the 4th and final class of this basic workshop for beginners, where we will be discussing very important aspect of risk and reward ratio and position sizing and risk management. After that, and the trade plan and journaling your trades, which will give us a final touch. And with these 4 classes, any newcomer can understand what this field is, how we forecast, and how we can trade. And after that, you can come to master classes for various technical analysis and other studies. Wish you all the best. See you in next class. Thanks.